Hello, and welcome back to the channel. I'm Algabot, and today we're taking an educational look at an expert advisor for MetaTrader 5 called Engulfing Boundary Hedge. This is a pure price action approach. It uses no indicators at all. There are no moving averages, no oscillators, and no volatility bands. Instead, it reads raw candle geometry and builds its own pivot boundary from recent highs and lows. By the end of this video, you'll understand how it looks for an engulfing candle at a support or resistance boundary, how it sets its stops and targets for market structure, and how its hedging layer responds when a position moves against it. Let's get started. So what is this expert advisor actually doing? At its heart, Engulfing Boundary Hedge is a short-term, price action strategy. It does not rely on any classic indicator. Everything it knows about the market comes from the candles themselves. On every closed bar, the strategy scans a recent window of price, by default the last 20 bars, and from that window it measures the highest high and the lowest low. Those two values become the edges of the range. From them it calculates a classic floor pivot, and from that pivot it derives two reaction boundaries, an upper one it calls R1 and a lower one it calls S1. Think of these as the lines where price has historically reacted. The entry signal is a candle pattern that many traders already know, the engulfing candle. That's a candle whose body completely covers the body of the candle before it. The strategy reads this purely from the open and close prices, and it also checks that the body is large enough relative to the candle's own range, which filters out small, indecisive candles. The strategy combines that pattern with the boundaries in two ways. Its primary behavior is to fade a boundary, meaning it looks for a reversal back into the range. Its secondary behavior is to follow a clean breakout when no reversal setup is present. On top of all of that sits a hedging layer, which is where the name comes from. Each main position can open one opposite position if price moves far enough against it. In terms of who this is built for, it's an educational example aimed at active intraday conditions, the kind you'd see on a liquid currency major or a metal on a 5-minute or 15-minute chart. Because it can hold a buy and a sell at the same time, it requires a hedging account. As always, trading involves risk, and losses are a normal part of any approach. This video is information only, not financial advice. Let's walk through the logic step by step. Once a bar closes, the strategy rebuilds its map from the window of bars before the signal. It finds the highest high and the lowest low, and the distance between them is the range. It then computes the pivot as the average of the high, the low, and the prior close. From the pivot, it derives the upper boundary, R1, and the lower boundary, S1. These boundaries are the reference levels for everything that follows. Next, the strategy examines the last completed candle and the candle before it to see whether an engulfing pattern has formed. For a bullish engulfing, the earlier candle must be bearish and the latest candle must be bullish, with its body fully covering the previous body. A bearish engulfing is the mirror image. The body must also be at least a set fraction of the candle's range, by default 45%, so that weak, thin candles are ignored. Now the strategy chooses a direction, and the order of priority matters. Its first preference is the reversal or boundary fade. If a bullish engulfing forms and its low dipped down to or below the support boundary S1, the strategy signals along, expecting a snapback into the range. If a bearish engulfing forms and its high reached up to or above the resistance boundary R1, it signals a short. Only if neither reversal applies does it consider a breakout. A bullish engulfing that closes above the range high plus a small buffer signals a long that follows the break upward, and a bearish engulfing closing below the range low minus that buffer signals a short downward. Before any position opens, the strategy checks that there isn't already a base position on that side, and it skips the entry if the spread is wider than the allowed maximum. Stops and targets come from structure, not from volatility indicators. The stop distance is a fraction of the measured range, by default 35%, and the take profit is placed at a reward multiple of that stop, by default 1.3 times the risk. Finally, the hedging layer runs on every tick. If price moves against a base position by a set fraction of its own stop distance, by default 70%, the strategy opens one opposite position so the adverse move is captured rather than simply absorbed. When the base recovers back to its opening price, the hedge is closed. And if the base itself closes at its stop or target, any leftover hedge is closed as well, keeping the book tight. Let's read through the actual MetaTrader code. At the top are the input parameters you can adjust in the strategy settings. Lookback sets how many bars build the pivot and the range. RangeStopFraction sets the stop distance as a fraction of that range, here 35%. Reward ratio sets the target as a multiple of the stop, here 1.3. HedgeTriggerFraction decides how far an adverse move must travel before the opposite hedge opens. And Engulfing Boundary Fraction sets the minimum body size for a valid pattern. Below that is the decision block. The strategy checks 4 conditions in order. If a bullish engulfing has a low at or below the support boundary S1, it sets the long flag. If a bearish engulfing has a high at or above the resistance boundary R1, it sets the short flag. The last 2 lines handle breakouts above the range high or below the range low when no reversal applies. Then the orders are placed. The stop distance is the range fraction with a minimum distance floor for safety. For a long, the entry is the ask price, the stop sits below it, and the take profit is the reward ratio times the stop above it. The send order call passes those into trade.buy. For a short, it mirrors everything. The entry is the bid, the stop sits above, the target sits below, and the same helper calls trade.sell. Notice both sides share one clean function, so the long and short logic stay perfectly symmetrical. Now let's bring it all together on the chart and walk through both a long and a short, candle by candle. Across the price, you can see the map the strategy has built from the last 20 bars. The range high sits at 1.0900, and the range low sits at 1.0830. Inside those edges are the 2 reaction boundaries. The resistance boundary R1 is at 1.0890, the support boundary S1 is at 1.0840, and the pivot rests between them at 1.0865. Watch the opening candles. Price is drifting down from the middle of the range toward the lower edge. The second and third candles are bearish, pressing price down until the candle low pushes right into the support boundary S1. This is exactly the zone the strategy is watching for a reversal. On the next candle, a strong bullish candle forms, and its body completely covers the previous bearish body. That's a bullish engulfing pattern, and crucially, its low dipped to the support boundary. Both conditions are satisfied, so the strategy signals along. You can see the buy entry marker appear right there. Notice how the stop and target are placed. The stop distance is 35% of the measured range, so the stop sits just below the support boundary and the recent low. The take profit is set at 1.3 times that stop distance above the entry, reflecting the reward to risk ratio of 1.3. From here, price does what the setup anticipated. The following candles climb steadily, candle after candle, lifting away from support, through the pivot, and up toward the top of the range. By the 6th candle, price reaches the take profit target and the long position closes for a structured gain in this illustration. Now the second half of the story. After tagging the upper area, price stalls. The candles near the range high start to lose momentum, and one bullish candle prints right up against the resistance boundary R1. On the very next candle, price opens higher but then reverses hard, closing well down and forming a bearish engulfing that swallows the prior bullish body. Because its high reached the resistance boundary R1, the strategy signals a short, and the sell entry marker appears. This time the stop sits just above the resistance, and the take profit is projected 1.3 times the stop distance below the entry. From there, the move unfolds in the strategy's favor. The candles roll over and step down, away from resistance, back through the pivot, heading toward the lower part of the range. By the 12th candle, price reaches the downside take profit target and the short closes. And remember the hedging layer running quietly underneath all of this. If either of those positions had instead moved against itself by 70% of its stop distance, the strategy would have opened one opposite position to capture that adverse continuation, then lifted it once the base recovered to break even. That's the protective idea built into the name. Of course, not every setup plays out this cleanly, and losses are a normal part of trading. This is an illustration of the logic, for educational purposes only. So that's a complete walkthrough of the Engulfing Boundary Hedge Expert Advisor. We saw how it builds its own pivot boundaries from recent highs and lows, how it reads an engulfing candle at support or resistance to signal reversals, how it follows clean breakouts when no reversal applies, and how its structure-based stops and targets are calculated. We also looked at the hedging layer that opens an opposite position when a trade moves against it. Remember, everything here is educational information only, and not financial advice or a recommendation. Trading carries real risk, and losses do happen. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with the strategy you'd like me to cover next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.